Okay, so this section is going to be me reacting to some of the very large amount of inept officials. I'm just going to play a clip and then I'm going to chime in whenever I feel like it. But for the most part, you'll be able to tell how stupid they are. And just remember, these guys are in charge of a lot of what goes on in the economy. So, yeah, quite a horror story. Here we've got Senator Elizabeth Warren.
So Americans are struggling with rising costs, and all eyes turn to the Fed. Last week, you announced that the Fed would raise rates by 0.75 percentage point, the biggest increase in nearly 30 years. So let's talk about what the Fed is and isn't doing when it raises interest rates to try to bring down inflation. Let's start with gas prices. The price of gas is up 40% since Russia invaded Ukraine in February. Chair Powell, will gas prices go down as a result of your interest rate increase?
The price of gas was already sort of going up anyway, and although the invasion did make it worse, it's actually come back down. Now it's only going to go back up later, but it's kind of too early to tell when. Or at the very least, I haven't had the chance to actually look at it, but either way, we'll continue.
I would not think so, no.
Okay. That matters because gas prices are one of the single biggest drivers of inflation. Energy prices overall drove a third of the inflation last month, but the Fed's tools, as you say, have no impact here. So let's look at another necessity, food. Price of groceries is up nearly 12% this year. Americans feel the pinch. No matter how much groceries cost, people still got to eat. Chair Powell, will the Fed's interest rate increases bring food prices down for families?
I wouldn't say so, no.
Okay. So a Fed increase won't bring down these prices. And why? Because rate hikes won't make Vladimir Putin turn his tanks around and leave Ukraine. Rate hikes won't break up monopolies. Rate hikes won't straighten out the supply chain or speed up ships or stop a virus that is still causing lockdowns in some parts of the world. So let's talk about what interest rate increases can do. Chair Powell, you said last week that interest rate increases, quote, moderate demand. Can you just explain a little more about what that means?
Sure. So we think about interest rate increases as affecting financial conditions and then the economy through three broad channels, the first of which is interest-sensitive spending. So that's durable goods and automobiles and things like that. So interest rates go up, people's demand for as a result of higher interest rates will moderate or decline so that supply and demand can get into better balance. The second channel is just asset prices generally. Interest rates, as they go up, will cause asset prices to moderate across the economy, and people spend a little bit less out of their lower level of wealth. The third channel is the exchange rate, which is really just another asset price, and that just basically as the dollar strengthens. As rates go up, the dollar would strengthen, which would tend to drive.
Yep. So as the US economy has their interest rates raised, it increases their dollar, which was basically the crux of my foreign exchange investments lately. I've actually jumped out of a lot of them. While I was on holiday, 2 of them got liquidated, and I lost probably about $1,000 US. Obviously a bit hard to keep track of that stuff when you're overseas, but it's also a combination of just other banks raising their rates and people just being a little bit stupid because they interpreted what Jerome Powell said at his last meeting at the time of recording. I don't know when you're actually watching this, but the last meeting, he sounded quite hawkish to me, but a lot of people thought he was sounding dovish, and they thought that perhaps the Fed was going to start raising rates slower or maybe even start reversing, which is why the stock market had a rally around July-ish, which obviously lowered the value of the US dollar, which fucked up a lot of my foreign exchange investments, but you live and learn.
I appreciate this, and I do appreciate the explanation, but let me just see if I can just put a little more plain vanilla explanation of what's going on here. if I understand what you've said and what economists are saying across the board, is that when you raise interest rate, there's going to be less money to invest. And that is, it's going to dampen business investment. Is that a fair statement?
I think the idea is to
Makes it more expensive
moderate demand
to invest,
so that it can be in better balance with supply. And
so
the current
it's going to make it
situation,
more,
demand is well in excess of supply in some areas of our economy.
more expensive to invest.
Yes, it does make it more expensive to invest. That's kind of the point. If less people are investing, then that slows the rate of inflation. And also higher interest rates means the banks don't lend out as much, which means there's less money being printed into the economy because banks issue credit, which inflates the money supply. The money doesn't actually come from anywhere when you get a loan from the bank. They just type a few buttons and money's just being printed into the system.
Which in turn is going to throw workers out of work. And when they're out of work, they have less money to spend.
Yes, unfortunately, there's going to have to be a lot of unemployment to fix the inflation, but if you let inflation keep going the way it's going, we're going to have a lot of unemployment anyway.
So I get that rate increases stop companies from spending money to build new plants or to buy new trucks or to hire new people. Right, Chair Powell? When money's more expensive, they're less inclined to do that. I think that's what you just said on asset pricing, right?
Well, in the labor market, you have, as you know, you have a situation where there's a shortage of workers, and there are two job vacancies for every person who's actively looking for work.
So I don't exactly know where Jerome Powell's getting this figure of 2 job vacancies for every unemployed person, although it's kind of outdated at the time of this recording. Even back then, I don't know where that was coming from. I remember seeing something that delved into this figure and found out that it wasn't quite true, but I never actually got around to making a Twitter or Instagram post about it because at the time I was rather busy with a bunch of other stuff. So again, another flawed statistic. There are 3 types of lies: lies, damn lies, and statistics. However, statistics are important, but we'll move on.
Part of this is to get the labor market back into balance.
Well, I appreciate you call it back into balance. What I'm trying to get at, though, is what does the tool of raising rates do? And part of what you just said is that it increases, in effect, the cost to invest, to buy those trucks or new plants or to hire new people. The reason I raise this and the reason I'm so concerned about this is rate increases make it more likely that companies will fire people and slash hours to shrink wage costs.
No shit.
Rate increases also make it more expensive for families to do things like borrow money for a house. And so far, the cost this year of a mortgage has already doubled. Inflation is like an illness, and the medicine needs to be tailored to the specific problem. Otherwise, you could make things a lot worse. And right now, the Fed has no control over the main drivers of rising prices, but the Fed can slow demand by getting a lot of people fired and making families poorer. And while President Biden is working to increase energy supplies and straighten out supply chain kinks and break up monopolies and bring down prices,
no, he's not.
You could actually tip this economy into recession.
Most of us in the economic space already knew this. Just check the timestamp for when I release my recession is coming video.
So I just want to say, you know what's worse than high inflation and low unemployment? It's high inflation and a recession with millions of people out of work.
There's going to be high inflation anyway because money supply. I'm kind of a bit surprised she doesn't know about this. But then again, most of them don't, so with any luck in the future, I'll be able to use videos like this and my Twitter and Instagram posts to show that I kind of at least have a lot better of an understanding about the economy than a lot of people in government positions, so hopefully that'll land me a juicy paying job there. But anyway, that was Senator Elizabeth Warren. Let's go on to Christine Lagarde, head of the European Central Bank.
We expect inflation to remain undesirably high for some time, owing to continued pressure from energy and food prices and pipeline pressures in the pricing chain. higher inflation pressures are also stemming from the depreciation of the euro exchange rate. But looking further ahead, in the absence of new disruptions, energy costs should stabilize and supply bottlenecks should ease, which together with the ongoing policy normalization should support the return of inflation to our target. The labour market remains strong. Unemployment fell to a historical low of 6.6% in May. Job vacancies across many sectors show that there is a robust demand for labour. Wage growth, also according to forward-looking indicators, has continued to increase gradually over the last few months, but still remains contained overall. Over time, the strengthening of the economy and some catch-up effects should support faster growth in wages. Most measures of longer-term inflation expectations currently stand at around 2%.
Good luck. There is no chance that inflation in the Eurozone is going to be anywhere near 2% for several years yet, at this rate anyway.
Although recent above-target revisions to some indicators warrant continued monitoring.
That one was a little bit harder to react to because it sounded like she was reading off some sheet. But you'll note that she said this should happen. Well, what if it doesn't? So not once did she mention anything about the fact that she could help lower inflation by jacking up interest rates. But I did mention before that they don't really have this option, but what they should have done is they should have done it a lot sooner. So a lot of them have made their bread and now they've got to eat it. So next up, we're going to have Andrew Bailey, the Governor of the Bank of England.
It is, of course, a very challenging situation. We're facing a very big shock to inflation. And unfortunately, in the last 3 months since we last did a forecast in the Monetary Policy Report, that challenge has got much bigger. It's coming from predominantly and overwhelmingly from one source, which is energy pricing, and particularly gas prices, and I'm afraid it is coming from the actions of Russia.
Although in a way it is coming from the actions of Russia, it's actually coming from the sanctions the West imposed on Russia. Now, political debate aside, I'm not saying that Russia shouldn't have been punished for invading Ukraine, but the West should have put a little bit more thought into it before basically shooting themselves in the foot.
Now, our concern is that, of course, we have to bring inflation back down to target from a very high level. Now, other things equal, we think it will come down. The question for us is, are other things going to be equal? And really is about the question of, is inflation going to be persistent and become embedded? Now, we do see risks on that front, and that's why we've acted. And the risks are, and this is where there is a domestic element to the story. We've had a shrinkage in the domestic labour force over the last 2 years or so, during the COVID period. And so when I go around the country talking to firms, as I do a lot, they are still saying to me two things, really. One, we're struggling to hire people. Two, actually we can increase prices. We're not hitting resistance on increasing prices.
For now, eventually the consumers are going to run out of discretionary spending, and then companies aren't going to be able to get away with raising their prices much more.
Now, we understand, obviously, the situation, but it concerns us because that's one way in which inflation can become more embedded. And then we would have to raise interest rates by more than otherwise.
So this is actually a good call from Bailey. He's actually correct here. If they don't tackle this now, companies are going to just keep raising their prices, which means that the central banks are going to have to raise interest rates even more to cull inflation. So
our action today was very, very clearly, we feel we've got to take stronger action, as we said we would, because we changed the language of our sort of, in a sense, forward view back in June to say that if we saw this evidence of persistence, we'd act forcefully, and that's what we've done.
Right, and wage pressures certainly are building. Pay growth is averaging anything between 5% and 6%, depending on how you're looking at it. Do you think the wage pressures would be less pronounced if the Bank of England had tightened faster and sooner?
I don't know who this reporter is, but that's a good question.
than what you've delivered already?
Well, I think it's important to bear in mind the shocks that we've been subjected to, and in a sense the point at which we can understand what these shocks are, because they're coming from outside. So we don't make policy with hindsight. I would say to people, I think when we were sitting here as we were a year ago, I think if we'd said there's going to be a war in Ukraine, we'd have said, really? That is not things that frankly were foreseen, and I think could be foreseen. So I think the debate around, well, if you didn't raise interest rates sooner, wouldn't it have been different? Frankly, is made really by people who think that policy making is done with hindsight, and I'm afraid it isn't.
Well, when you drastically increase the money supply and drastically cut interest rates, of course it's going to lead to inflation, because inflation is always and everywhere a monetary phenomenon. And if you've raised the amount of money in the economy that much, and you haven't increased output by much, a lot of money chasing a set amount of goods equals higher prices across the board. It's basic supply and demand in a way. If you've got the same amount of goods, but everyone's got a lot more money, all that money chasing fewer goods is going to raise the prices of those goods. There's no new set equilibrium here, unless the new set equilibrium now is much higher prices. So, I mean, yeah, you don't make policy decisions in hindsight, but, I mean, a lot of us in the finance economic space on like YouTube, Twitter, etc., could see this coming from a mile away. And central bankers around the world didn't, even though you guys are the ones in charge. So, yeah.
Well, it is tricky. Turning to the short-term interest rate curve, the market assumes that you will go for, let's say, another 150 basis points worth of hikes over the course of this hiking cycle, but then start cutting interest rates. What do you make of the argument that the Bank of England have to hike now in this small window before the economy starts turning south?
This is exactly what a lot of people in the whole finance space have been saying. They need to drastically raise rates right now, and then if they're going to slow it down, do it later. The Maverick of Wall Street talks a lot about this as well. Also, if they're only going to raise it by 100 more basis points, that's still way under inflation, so they need to go a lot further than this.
Well, we take our decisions based on the evidence that we see now. So, it's not a sort of case of us sitting down and saying, gosh, if we don't do it now, we're not going to be able to do it in the future. I mean, our decisions are entirely based on what we see today. Now, you're right about the profile of the market. Now, look, we do not endorse the market curve. We use the market curve as a conditioning tool for our forecast, but it doesn't mean to say we endorse it. So I'm not going to give a commentary on where we think policy is going to go relative to where the market thinks it's going to go. I think it's interesting, as you say, that the market, and it's not just, of course, our curve, actually, you can see it in other curves as well, other countries, thinks that we're sort of going to go up and come down again. And again, without wishing to endorse in any sense, I think the rationale, behind the market thinking that is they think you're going to have to act more aggressively early on, but you may actually have to go above what would be the equilibrium level, if you like, and then come down again to sort of get inflation out of the system. And I can understand why the market thinks that could be the way we go. I'm not endorsing that, but I can understand why. I mean, it's interesting if you go back in time, because I think people would have said, well, that's a policy mistake. And I think the rationale and the thinking in the market now is not so much it's a mistake, but actually it's a path that would deal with expectations, get expectations under control, and then you can bring rates down. Now, we're not endorsing that path, but I think it's an interesting way in which the market has evolved.
And just a question on financial conditions. I noticed today you obviously hiked by 50 basis points, and yet the pound is about half a percentage point weaker. So from that perspective, the interest rate hike hasn't really transmitted through, quote unquote. Does that worry you? Because obviously a cheaper pound means more inflationary pressure.
Well, cheaper pound means more inflationary pressure, which is something I mentioned earlier in the video too.
I think you always have to judge the weight of the short-run reactions in markets against what people were expecting. I mean, market reactions are always against what they were expecting. I think you also should, I always feel it's interesting to look at how they react in what is it, the 2 or 3 hours. But actually, let's see where it is next week and thereafter. So, yes, of course, I follow it closely, but I think we have to be a bit careful about over-interpreting very short-run movements.
Hi, I'm Joanna Bersetchi. And
Oh, okay, so that's what her name is.
Governor, tell us why someone who is already facing huge cost of living pressures around energy bills now has to face increases to their borrowing costs on top of that.
It's a very important question. It's probably the most important question, and I realise the distress, because it is a very difficult situation to both have such a large increase in inflation and to be forecasting that there will, I'm afraid, be a recession, and to be saying we have to increase interest rates.
So this is refreshing to see someone in Andrew Bailey's position of power admitting this. We haven't really seen much of this in the last year or so.
And the reason is this: we've had this very big, huge external shock. In the 3 months since we last did a monetary policy report, the change to the whole energy price, particularly gas price regime, has been massive. And I'm afraid that has to be put at the door of Russia. There's no question about that. Now, very reasonable to ask the question, so why are you raising interest rates in that context? Because you can see that, yes, inflation's going to get very high, but, other things equal, it ought to come down again, and we do project that, actually. The worry for us is, are other things going to be equal? And the really difficult situation, and this is why I'm afraid we have to do it, is if we have more persistent inflation, that is harder for everybody. We'll have to raise rates by more, and those people, and particularly those on low incomes, will be even more affected, and that's the thing that concerns me.
So is it the case this has got to hurt if it's going to work?
The reason we're doing it is because if we don't get inflation under control, if we don't bring it down from where I'm afraid it's got to go up to because of, of these huge energy shock that we're having, if we don't bring it down, then the damage and the distress will be even greater.
110% spot on. So he's got it. But the problem is it's a bit too late for the UK economy. And also, where was this sort of sentiment months and months ago when it was needed the most?
The main pressure is external. Gas prices, everyone understands that. Is it really the case that you need to tighten the screw at home? Is that judgment call? Are you sure about that judgment call?
There's more to inflation than just gas prices, reporter.
You're right that the main pressure is external, and that's going to feed through into inflation, I'm afraid, over this winter. We do think it's going to come down, going through next year and beyond. But we have got another thing going on, which is domestic. The size of the labour force has shrunk. There are fewer people, working in the economy, and that's affecting. When I go around the country, and I spend a lot of time going around the country, the first thing that every firm wants to talk to me about is, I can't hire enough people. And we've got this situation where we're saying, well, I think we can already see the economy slowing. It's going to get worse, I'm afraid. And yet firms are saying two things to me. One is they're still able to increase prices. They're not getting resistance, and they just can't hire enough people. And of course, that does have an upward effect on costs.
And you've talked about wages in the past, somewhat controversially. In the context of these inflation numbers, above 10%, well into next year, is it really reasonable to ask people to accept rises, below 5%?
If everybody tries to get ahead of inflation, then we get inflation more embedded, we'll get more persistent inflation. And that's why I said, particularly, if you seek to beat inflation, we'll get into an upward, trend, and we will have to raise interest rates even more then, and that will be more painful.
Okay. Much noise politically. We have a contest to become Prime Minister. I know you don't want to get directly involved, but there are questions about changing the mandate of the bank and some blame around Liz Truss, certainly her campaign, at the bank's door for this. Is this the time to be addressing the work you do here, or is that risk making a difficult situation even worse? Well,
I'm not going to get involved in the campaign and the leadership election to be leader of the Conservative Party or the next Prime Minister. What I would emphasise is that I think central bank independence is an absolutely key part of the economic system in this country and in other countries. It's an important part, and never more than now. This is the biggest test of our system in a quarter of a century that it's existed for.
Last one, if I may. You talked about a judgment call, walking this path with the consequences on either side of getting it wrong. Have you thought about the consequences if you and your colleagues have got this wrong?
We don't look at it from the point of saying, personally, what if we get it wrong? This is about for the country and for the economy. So we spend a lot of time looking at those risks.
And you're confident you got it right?
We think this is undoubtedly the right thing to do. But we will be back in, about 6 weeks' time, because that's the next Monetary Policy Committee meeting. And we will have to go all through the evidence again. There'll be new evidence, and we will do that all over again.
So that's it for all the reaction parts to our inept leaders. There's countless other examples, but I could do a 5-hour video on that. But I think you get the point. Now, although Andrew Bailey wasn't exactly looking inept here, from what I've seen this time last year, he wasn't acting this way when he should have. So, unfortunately, you can't just reverse some of the bad decisions you've made by making up for it later, especially when you're this important to the overall economy.